First off, welcome to our webinar. My name is Chad Harmon. I'm one of the partners here at A&I Financial Services. And for those of you new to the firm, for the last 35 years, our mission has been to help a small number of successful families and individuals just like yourself grow and protect their investments and gain more choice and control over their taxes. We do have a large crowd here for the call today. We are going to be recording the call, and so I wanted to go through a few housekeeping items. For that reason, we have disabled video and audio for all of the participants, with exception to our speakers. So I want you to lean on the chat feature in the bottom middle of your screen. If you do have a question that pops up during the presentation, please submit it via the chat feature, and Karl or myself will make sure that all your questions get addressed before we hop off of the call today. We also have some events I wanted to brag about. Before we kick things off, we have a blood drive on Valentine's Day, February 14th. We're going to be helping support local children's hospital. It's going to be at 8:30 in our parking lot. We do have limited spots, so if you're interested, please let us know and we'll make sure we get you RSVP'd. Secondly, we've been doing a lot of work on our podcasts, which have become very popular. Karl, alongside some of the brightest minds in town, have been getting together on a regular basis and speaking to issues that affect us all. Recently, they had a great one relating to the fires that unfortunately our friends and loved ones had to go through out in Boulder. But there's all sorts of topics. You can access those podcasts via the resource link at the top of our website. Go down to investment advice videos on the bottom, and you'll be able to see all of those podcasts. You can also access them wherever you access your local podcast, your favorite podcast. Just Google or search Expert Network Team, and they'll pop right up there for you. As far as today's conversation, the topic is our 2022 investment commentary or outlook. I think it's an exciting one. Can't wait to hear what Karl has to say. Mr. Karl Frank is our featured speaker and president of our firm. I know many of you are familiar with him, but I wanted to share a little bit of information as far as an introduction for those that are not familiar with Karl. And I thought playing a little game of Did You Know would be fun. So many of you know Karl is an avid academic. He currently holds a CFP designation, a slew of insurance licenses, alongside 3 master's degrees. What you may not know is that Karl is an avid adventurer. When he's not chasing his kids down the mogul runs at Winter Park, he has been training to summit some of the largest peaks in the world, including Mount Kilimanjaro, which I believe is next on his bucket list. So we'll have to wish him luck on that endeavor. You may be familiar that Karl has really cemented himself as a pillar in the local financial planning community. He is the founder of Colorado Financial Planning Day, which he has supported and helped direct for over a decade. He has held the director position for many local nonprofits. Karl was asked to speak to over 1,000 advisors at the $1 Million Roundtable National Conference, which is a huge honor. It is the cream of the crop of our business getting together to all make each other better at what we do. And he has been featured regularly on local news stations, including Channel 4 and Channel 9 and Fox 31. What you don't get to see is that behind the scenes, Karl is the hardest worker I've ever met. I can assure you that nobody is putting in more time, thought, and consideration into bettering the lives of those people around him than Karl does. He approaches life through a lens of giving and has a relentless appetite to be the best he can possibly be for his clients and the families that trust us with all they've worked for. So with that said, I will proudly hand things off to my partner, Mr. Karl Frank. You're in store for a treat.
Wow, thank you so much, Chad. That was really kind. I just don't even know how to begin now. Let me recover. Thank you. That was very kind. I appreciate that. And it's an honor to work for such wonderful people like our clients. Today's conversation, these are ideas I find interesting. I hope you find some nuggets to think about that you can talk to your financial planner about. These opinions are my own. They're not necessarily the official opinions of our company or the investment policy committee. That's important because the right way to invest is to diversify by strategy, and our team benefits from a diverse set of opinions from our investment committee, our investment managers, and the research analysts who we trust. All right, today's conversation is going to focus on some of the biggest themes of our times, and we're going to ask 2 questions of each of the themes. We're going to ask, what does this mean for our investments, and what does it mean for our real-life, long-term financial plans? Themes for 2022, include the COVID endemic, China versus the world, the USA versus itself, inflation, interest rates, the S&P 500 or the S&P 5, I'll tell you what I mean by that, climate change, cryptocurrency, technology, and finally, we're going to end with a little house party. You know, we're going to talk about these issues in relation with our investments and more importantly, in relation to our long-term real-life financial plans. You know, we can change our plans, but we can't change a single thing on this slide. We can form financial plans in alignment with our goals, relationships, values, and everything that's most important to us, but we can't change interest rates. We can't change inflation. We can't change China. We have only one vote, and so our ability to affect the U.S. government sometimes seems minuscule. And I'm going to argue today that our one topic largely outside of our control is the Earth's climate. So we're going to face these trends with either courage or fear. Whatever we choose, we're going to face them. Let's take a look at them. COVID is the single biggest story of our time. We've had a number of these stories of our lifetime, but this one too will someday fade away. Eventually, living with COVID is going to start to feel more normal, similar to the flu. It may be that 2022 is that year. I certainly hope so. I don't know that any of us don't hope that. Let's look at two resources that we use here at our firm that I think you might find interesting. The first one's from one of the world's largest financial services company called BlackRock. And they have something they call the COVID tracker. They update it every single day. And this chart, this heat map, if you will, is a 7-day moving average of the number of deaths per million people in that country. And you can see that these numbers are very, very small. In America, among the worst in the world right now, has only 5 deaths per million people from COVID-19. And you can see the rest of the world is smaller than that. So the deaths are very, very small. This is making the news. I think it's really important that we reiterate what I view as good news. The COVID pandemic is killing less people per million than it ever has since it came out. So this is very good news. Now, the positivity rates are going up. So even as the number of people get more and more affected by COVID, less and less of them are dying. So together, these two things are good news. Perhaps maybe, and this is outside of our scope, this is something that will become an endemic in the very near future. What we will focus on is how this affects our investments. Now, second thing I wanted to look at, that's the first part of the COVID. So let's look at the economy. Let's take a look at that. And a place that we look at is The Economist magazine. You've probably heard of The Economist. And they have a nice chart. They update it frequently, although not quite as frequently as the other company. This is only a few days old, January 18th. And they're looking at the economy returning to normal. And the sum of all these bar charts that you see here is that we're 75% back to normal. So if 100% before COVID, the economic activity were the right-hand side of this chart, then you'd see that we're 75% of the way there. Now, we're less than half the economic activity for flights, for cinema, for sports attendance. These types of things are way down. But retail, we're 93% of the retail activity. Time not at home, we're getting out. We're not traveling the world. We are using public transportation a lot. We're going back to the office a lot. And this, for those of us who live in Denver, might be astonishing. According to The Economist around the world, we still only have 2/3 of the traffic that we had before COVID. Maybe not in Denver, but for the rest of the world, that's true. So the bottom line is, eventually COVID will become endemic, similar to the flu. We're going to learn to live with it. And there's a chance that 2022 is that year. Now, COVID's the first of the topics and the biggest current topic affecting our financial plans, and it's completely outside of our control. It's alien. Speaking of an alien force that's completely outside of our control, let's take a look at China. A huge theme of our times, which has been true for years, and I predict will continue to be true for years, is the East is rising and the West is declining. This is what the Chinese say. That is a real challenge that confronts our country. China is under the control of a single party, the communists, and they have a communist goal of common prosperity. The Communist Party is increasingly under the control of President Xi, and so the single party is becoming a single man. President Xi issued clampdowns on technology and finance companies, which are expensive and counterproductive to China's economy. Clampdowns on video gaming and private tutoring are illustrative of Xi's goals, which are far greater than economic. They're societal. Kids can't play video games more than a certain number of hours a day. Private tutoring companies favor wealthy Chinese citizens, and that's not fair to the rest of society. That's not good for common prosperity. On the economic front, and they've walled off China. My goodness, the Chinese response to COVID is to shut everything down. And on the economic front, China is going its own way. Evergrande, with a huge debt to pay off, is illustrative of the country's challenges, namely slower economic growth than they've had in years past. And just this week, while the rest of the world is either promising to raise or has already raised interest rates, China lowered their interest rates to stimulate that growth. It truly is China versus the world. They have a huge population, more on population in a few minutes when we talk about climate change. Most importantly, for our investments and our real-life long-term financial plans, we must consider China and the effects that country has on the people all around the world. The Defense Department in the United States of America labels China as our #1 threat, and our country's companies are changing how they do business with China. It used to be a joke, the cheap Chinese imitation, right? Now it's quite different. It's not quite the opposite, right? We don't have an American cheap imitation. We're neither cheap nor are we an imitation of anything Chinese. But we have lost the dominance that we used to have, and we may never regain the dominance, if for no other reason than the law of large numbers. There are just so many more of them than there are of us. And so this challenge presents great investment opportunities. Our countries are battling it out for the future of the world. Eastern common prosperity versus Western independence. And the companies in the USA will continue to be more innovative because they're more competitive with each other. But China will be the biggest competitor of them all. And it's not clear that the forced hand of the Chinese is a competitor that anyone can compete with, at least not over any short period of time. To battle this type of threat, we must have confidence and faith in the free markets, in the invisible hand of the free markets, in free speech, in conservative values and liberal progress, in both this side of the aisle and that side of the aisle. Because you can't talk about China if you don't talk about our beloved USA. USA politics makes the headlines here all the time. And if you're not careful, you're going to start to believe what you read, see, and hear, and you might become clinically depressed. So let's take a look at the 3 absolutes for U.S. politics. First, political infighting. It's good for investments. The less the government changes the rules, the more the players on the field can play by the rules. The companies and the citizens and the consumers can get things done when the rules aren't changing on them. So that's the good news about political infighting. The rest of the news you already know. It's really not very healthy, is it? I mean, it's horrible, and we hear it all the time. So I'm not going to spend any more time on the political infighting in the country, except to remind you that it's good for our investments, and that it's not the worst nor the first time we've had situations like this. The second point is that we have a history in our country to rally around common rivals. China may be the rival that we rally around. Russia may be the rival that we rally around. Think of 9/11. We are one disaster away from unification. And our fragile infrastructure could be the disaster that's waiting in the periphery, right? Last year, Colonial Pipeline paid $5 million for ransomware so that people in the South could heat their homes again. This could be the disaster, the one that's unforeseen. And whenever we have one of these disasters, our weaknesses will be exposed. We'll be scared. And naturally, many of us will want to sell out of our investments. But we must not. That's the challenge we face, to look ahead to see what may hurt us and not be afraid if it ever comes to pass. And if it never does, not to act in anticipation of the end of days in ways that hurt us today. What works is a financial plan in alignment with our values and goals and relationships, investments that pay homage to the plan, and honest conversations about the real threats that we face personally, individually, for our families, for our communities, the ones that mean the most to us and the ones that we can actually change. The real threat, over a long lifetime ahead of us, when we must use our investments to provide us income, is the loss of purchasing power. You know, when I started this presentation, I thought the two biggest topics that we were facing were were COVID and inflation. At least the ones receiving the most attention were COVID and inflation. But in comparison to COVID, inflation pales in comparison. It's not nearly as important as the COVID. In January of 2021, last year, we had an inflation rate of 1.4%. Today, it's 7%. What a year. What we do is make a mental mistake. We turn it around and we say, oh my gosh, what just happened is what's going to continue to happen. Watch out for that. You're making a big mental mistake. You're saying, oh, this inflation rate that we had for the last year, it's going to continue for the rest of my retirement, and it's going to destroy my retirement income, and I'm going to be eating cat food. Well, 1 year of drama does not a disaster make. What's happening is what economists call a wage price growth spiral. Wages are going up, prices are going up. The more the wages go up, the more the companies need to raise the prices to pay those wages. You get the picture. It's a vicious cycle of things going up. Now, spending on services would help, right? If we were able to get out and spend money on travel and restaurants and other things, then that would be great, and we could spend the money without having to see the prices go up. But the COVID has to end before that happens. So it's a tricky situation that we're in, and inflation could last longer, but as the COVID recedes, the inflationary prices too will recede. Here's the rub. Interest rates are still stubbornly low. If you bought a bond from the government, you'd have to wait 10 years to get your money back, and every single year for the next 10 years, you'd only get 1.7% from the government. If inflation is 7%, let's be kind and say that you only lost 5% per year. This is crucially important. When real yields are hugely negative like that, as they are today, this provides fuel to the inflationary fire, because the return on cash and cash equivalents is so miserable it destroys the desire to hold on to our cash. So what do? We spend the money. What happens when we spend the money? The prices go up. Think about the grocery store. You've seen the empty shelves, you've seen the higher prices. The rest my case. So what in the world is happening to interest rates, right? When are they going to go up? Well, I have here in my office 2 books. The first one is a biography of Paul Volcker. Paul Volcker was the Fed chairman at the end of the Carter years and the beginning of the Reagan years. He fought inflation. Might be illustrative. Great stories in there. Really interesting man. He fought inflation by raising interest rates. And then they got too high. So that's the story. And then the other one is the history of interest rates. And this you might find interesting, but the book is very thick and the font is very small. So let me just summarize the message I got out of the history of interest rates. They are so disconnected from reality. So much of the time, they have no predictive value, nor does anything in reality have any predictive value of interest rates. So you won't hear me make a prediction about interest rates. What we'll do is we'll talk to these guys. So on our left, we have Jeff Gundlach from DoubleLine, and on his left, we have Scott Minerd from Guggenheim, 2 of our most influential researchers. They're also known as Hans and Franz. They're here to pump you up. Jeff at DoubleLine is a little less grumpy than Scott. Jeff says, expect the Fed to start raising interest rates in June, and he'll do so for the rest of the year, and they might go up about 0.5%. Scott at Guggenheim says, ditto, the Fed's going to raise the rates in the second half of the year, but he expects rates to go up by about 1% during the year. So our guys are a little grumpy, Hans and Franz, because they manage bonds. And if you don't remember anything else from today, remember the cardinal rule of fixed investments. When interest rates go up, bond prices go down. Of the 2 guys, the big guy at Guggenheim is a little more grumpy than DoubleLine, but they're in agreement. Rates are poised to rise. So what does this mean for our investments? What does it mean for our long-term financial plans? I don't know. I mean, I do know, but I'm not going to tell you on the presentation. I'm telling you that you need to find out by contacting your financial planner at ANI Financial Services. Have that honest conversation. Take a look at your financial plan. Log into the financial planning website. Change some of the assumptions. See what that means for you. And while you're at it, ask them for the guardrails withdrawal policy statement. I think you'll enjoy it. So, we talked about interest rates. We talked about inflation. We talked about fixed income investing like bonds. Let's talk about the bigger half of our retirement income portfolio. Over long periods of time, equities provide higher average annual rates of return than other asset classes. This includes the inevitable years of decline, which number about 1 in 4 of every single period of time. Whenever someone asks, what's your prediction for the stock market? I say, it's going to be a good year. Because I'm right more times than I'm wrong. 75% of the time, the market goes up. And it goes up. If push comes to shove, I'll say, on average, about 10%, maybe 12% per year, plus or minus 15% around it. But that's completely beside the point. Last year, the S&P 500 had another stellar year. It exceeded those average returns by a lot. The S&P 500 represents 500 companies. The Dow represents 30 companies. The NASDAQ represents about 100 companies. If you're going to look at a benchmark, you might as well look at the big one, a broad array of companies. And so we tend to look at the S&P 500. But here's some inside baseball you might find interesting. Top 5 companies in the S&P 500 delivered nearly half of the returns of the S&P 500 in 2021. Half of the returns provided by 1% of the companies. Top 10 companies delivered more than half. 10 companies have more than 30% of the market share, and 2 companies have more than 13% of the market share, Apple and Microsoft. So the S&P 500 isn't diverse as you think. So what does that mean for your portfolios? It means a diverse portfolio likely didn't do as well as the S&P 500 in 2021. It means that if one of the key players in the S&P 500 has a bad year or a bad government event or incident, whatever might be the case, then that type of investment may suffer more than a diverse portfolio. What does that mean for our real-life financial plans? It means we need to be a little bit humble, a little bit thankful. Let's take a look at what Athena, one of our 2 key research partners, says about the stock market. Let's take a look at their key predictive indicators. We're going to bounce over to the Athena website, and they divide the economic predictors into 4 different categories. Each one of these is an academically proven way of predicting in some sort of way the stock market. The first category, and they categorize them by color. So if you do nothing else, you can just look at the color and you can say, oh, it's green, that must be good. Red must be bad. And yellow means, somewhere in between. The first category are these behavioral indicators, and they're normal. It means the market, believe it or not, as crazy as it may feel to you and I, or due for a correction, as some of us intuit must be the case, right? It's been so good, we must have a bad year coming. It's normal. The second one is economic, and those are all positive. In fact, the most recent economic indicators are as good as they've ever been. The third category is a warning sign, and that's valuation. More on that in a second. The last one is technical indicators, which just means that the market continues to go up. Well, these are all great, right? They make it very simple for us to understand. Let's take a look at the bad news, because the bad news sells. So we're going to talk about valuation. Well, things look pretty good, but the valuations look less than good. And what does that mean for us? Last year, in January 2021, valuations looked worse. That means that the earnings were really low in the wake of COVID, and the prices for the equities were really high. And we had a great year last year where the stock prices went up, but earnings went up even faster. So valuations are not a timing mechanism. Whenever you hear anything about any sort of a stock market indicator, or this guy predicts, or Robert Shiller says this, or some website said that, take it with a grain of salt. Take this presentation with me with a grain of salt. It's one piece of input for your individual financial plan. Your planner can help you with the rest of it. Oof, we're going into the big one, climate change. So if the bonds and the stocks are not making you feel comfortable, perhaps you want to warm your toes by the global warming fire. Climate change is everywhere. The trends around climate change dominating the headlines will continue, right? Much of the discussions around the impacts on the countries that are not as wealthy as the USA. But I'm going to argue that the climate change conversation amounts to a conversation about the crowded countries. The debates are going to continue between human condition and environmental condition, with the countries where the people are poor looking for sustenance and living at odds with the more wealthy countries with more wealthy people in more wealthy countries who want to do what's best. It's a hard line to walk without being patronizing or colonizing these countries. The most crowded countries will be the determiners of environmental change, or lack thereof. More than 1 out of every 3 people on Earth today live in India or China. And China is going to go its own way. They believe the East is rising and the West is declining. They believe in common prosperity for the people, not the planet. So the future of climate change, in my humble opinion, is a conversation between the crowded countries, which is to say it largely depends on President Xi. Now, this may seem dire, it may seem downtrodden, but do not despair. I see great investment opportunities. The countries with greater freedom and independence will be the ones who lead the technological change to ameliorate the environmental impacts. And directly related to our investment, BlackRock says that companies that don't address climate change are facing extinction. Finally, it's worth noting that not everybody in America believes in climate change. Let's hope the naysayers are right. If they are, we truly have nothing to worry about. But I'm a pragmatic person. We'll never know in our lifetimes who is right, because climate change is huge and it takes a long time to measure, and so complex it cannot be measured and cannot be controlled. Huge dose of humility goes a very long way when addressing an issue that's outside of our control, and nothing, in my opinion, is more outside of our control than this planet. Right, from one big complicated topic to another. You know, when I face a big complicated problem like cryptocurrency, I like to boil it down to absolutes. I say, first of all, who cares about crypto? Does anybody really care? Well, I'm here to argue the obvious. We care about it because apparently some people are making a lot of money using cryptocurrency. So that sounds like something we might want to know more about. Then we take a look at who's making the money. And the first, most important group of people making the money are the crowds of criminals all around the world who don't want to pay taxes, who don't want their money to be traced, and they want to be able to transfer the money all around the world quickly. They're not exactly, well, let's be honest, they're people that, among us friends, like, they're people we don't want to associate with, right? Ukraine is attempting to be the world center of crypto activity. Yeah, that Ukraine, right? I digress. The crooks are not the only ones who are using crypto, but they're the largest. There are the blockchain people. Blockchain is a technology that could possibly, perhaps, maybe revolutionize many different industries. So that's cool. Love the blockchain, hate the criminals. And finally, there's the super high-tech crowd, the DeFi crowd, DeFinance crowd, the folks who say they're reinventing money. You know, they're cool. They might, right? I doubt it. I think you'll probably doubt it too when we look at the next 2 massive influencers on crypto. They're much more important than the DeFi crowd. The first crop of people are a bunch of misfits, right? They just don't fit in with the traditional money paradigm. The second crowd of people are the polar opposites. They're the establishment, the big money. Corporations are all over crypto. Traditional technology and financial companies are spending oodles of boodle, as in real US dollars, to develop crypto gizmos. Years ago, we laughed at the company formerly known as Facebook when they invented their own imaginary currency. Now, Visa, MasterCard, Chase, Wells Fargo, Asian banks, European banks, they all want to do the same thing. QuickBooks, for goodness sakes, TurboTax. They're allowing small U.S. business owners and individuals to buy and track their own cryptocurrency. Do you think the big money is going to allow the DeFi rebels to destroy their Death Star? I doubt it. My money literally is on the big companies. Finally, the third absolute about crypto is that crypto is a direct threat to the governments of the world. China has already clamped down on crypto within its own borders. In 2021, in Beijing, they released their own version of cryptocurrency in Beijing and told the citizens of Beijing to spend it. and the people loved it. They got the free money from the government, they got to spend it, and China knows the threat. If and when President Xi and the Communist Party decides that crypto is a threat to the common prosperity, they'll issue their own, and it's story over. Here's the big threat, right? The U.S. government has bigger guns than you and I, and they will always demand that taxes are paid in U.S. dollars. They'll never accept them in Bitcoin or any of the others. Crypto is a direct threat to the U.S. government. It's being dominated by the big companies that are coming in. And so, bless your hearts, DeFi crowd and all the other people who want to keep it alive. The long-term trend has to be to zero. I have no idea what the short-term trends are for crypto, but these are the three absolutes that define the way I think about crypto and the reason why you want to talk to your personal financial advisor about your situation. Because what does that mean for our investments? Most importantly, what does it mean for your real-life financial plan? Ask your financial planner, right? But the odds are pretty good. They're going to tell you it means absolutely nothing. But it might be an entertaining ride. All right, let's talk about something really exciting, technology. Every company is a software company. Those of you who know me know I work with a small number of business owners. I met with one this morning, and she said, I am in the software business. They are not in the software business, but she knows technology is everywhere. It means everything to the future of her company, and she's putting the money and the effort into it, and that is a huge trend for our investments. Cloud computing is everywhere. We're all going to the cloud. That's not going to stop. Productivity is going up as we increase it, and we need to remeasure our productivity because there are so many solutions solving so many problems. It's just absolutely brilliant. There's huge futurism going on. This is a fantastic trend that's continuing, and it's going to continue in our future. Blockchain, I mentioned it before, it could revolutionize industries in ways we haven't even thought of yet. Think of the miraculous inventions that are happening in the medical field that got us a vaccine within just a few months of the discovery. Space travel is a real deal. It's actually happening. It's astonishing. I hope to have this year an interview with one of the astronauts on one of the spaceships so we can do that for a lunch and learn. And finally, related to that, superheroes, right? I mean, our culture, we have more superhero movies than I can recall in my entire life. The last time I remember us being so fascinated with superheroes was in the 80s when we watched Superman. We just come off of Star Wars, and this is a trend that's going on right now. It bodes well for investments. The 80s and 90s were some of the best years ever for equity investing. I think we're in the midst of that right now. And finally, the socially responsive endeavors that are going on around the world are huge opportunities for our investments. Electric power and storage is the trend. ESG, environmental, socially government investing, is the trend. Companies will, whether they believe in it or not, be adapting their businesses because that is what the vast majority of the developed world is believing. Companies will adapt that way. There'll be money to be made that way. Investments will change that way. What does this mean for our investments? Well, it means we're in all of these things in one way or another. Simply by holding a diversified, beautifully diversified portfolio of equities, we're already owning something that may become the next Apple or Microsoft. What does that mean for our long-term real-life financial plan? It means everything, because we're safe, we're secure, and we can outlast inflation. Why, it just makes me so happy, I want to throw a house party. Did somebody say house party? What is happening with real estate? If you're in Denver, Colorado, or Boulder, Colorado, or anywhere in Colorado, holy cow, you've seen your real estate go up in value tremendously. Well, a researcher, Gabriel Chodorow-Reich of Harvard, says, this incredible growth in the value of homes may continue. It may not be done. First, robust household balance sheets. We have a low debt payment as a percentage of our income. We have long-term fixed-rate mortgages that are extremely low. And finally, we have a low debt-to-asset ratio. Loans are harder to get today than they were in 2007. This is not a repeat of the prior housing bubble. because back then you could fog a mirror and get a loan. Today, loans are actually pretty challenging to get. We've got a lot more assets on our balance sheet. We've got more income, and we've got lower payments that we have to make to get those homes. First big reason is just the balance sheet. The second reason is people's willingness to spend more on their living arrangements. Think about working at home, as many of you are. Right? We're going to do that. We're spending more to improve the spaces where we spend more time. And finally, the supply constraints. We already have a low supply of homes, and we have a shortage of labor, and we have a shortage of materials. Some of this is temporary. Some of this, as the ports open up, as COVID recedes, is temporary, but some of it, argues this researcher from Harvard, are long-term, and it's likely to last. The home prices are not subject, according to this researcher, for a crash that could last a long time. So that's what the Harvard research say. What do we say? How does that affect our real-term, long, absolute, appropriate, personalized financial plan? Well, it's great news, of course, because many of us are homeowners, right? And the real estate is an important part of our financial lives. But most importantly, it's a part of who we are. And when we feel healthy at home, we are more prone to make healthier decisions with our finances. So I've covered a lot. 2022 is a pivot year. The themes could include, and I believe they will include, the COVID pandemic possibly becoming endemic. We certainly will be more comfortable living with it than we were in the years prior. The second big theme is China versus the world. It affects all of our investments. The third big theme is the USA versus itself, and the infighting is unpleasant, but it's good for the investments because the rules aren't changing. And this you might find fascinating. I made it through the political conversation, not talking about any US president, only talking about the Chinese president. And that, to me, is a pivot. The fourth big theme is inflation. It's likely to last. It's slow to come down. Fifth one is interest rates. They're still low, and there's no way to predict them. And we got Jeff, and we got Scott, we got Hans and Franz, and all the other researchers on our teams, and they're telling us they think they're going to go up a little bit, which means you might want to be talking to your financial planner about the next topic, the S&P 500, or the S&P 5, as I call it, investing in equities, in a beautifully diverse portfolio for your situation and your real-term, long-life financial plan. Finally, climate change. It presents investment opportunities that are real. Cryptocurrency is probably a zero in a long-term value, but it could be an entertaining ride. And you need to talk to somebody real about that. I don't see a real purpose for it. And then finally, technology is the answer. It's the answer to many of the questions we see above, many of the questions that are about to come in the future. And real estate, although it's way up, may continue to stay up. None of these things are in our control. All of these things have an effect on our investment portfolios. All of our investment portfolios pay homage to our real life, long-term financial plans. Our plans require a planner. And you have a wonderful one here at ANI Financial Services who would be excited to help show you their work on your behalf. So reach out to them. Okay, so Chad mentioned we've got a wonderful event coming up. It's our blood drive on Valentine's Day here Monday morning. Please reach out to somebody here. You can call the office anytime. You can email anybody here. You can reach out to your financial planner if you prefer. Just RSVP, donate blood. This is personal to us in the Frank family, and it's personal to at least one other financial planner here. All this blood goes to Children's Hospital directly. Many of you know a couple of years ago, a person who in the Frank family we love dearly nearly died, and Children's Hospital saved his life. And we have another member of our extended family who years ago had a similar experience with children. So it's really important to us that we give back. We'd love to have you participate with us, and giving blood is cheap, right? We'll give you a whole bunch of sugar and candy and chocolate and all sorts of good things, so please join us for that event. We're going to have other events coming up, but that's the next one. So for more information, here's a bunch on the website. I guess it's this way. And please reach out. Find the Expert Network team. The podcast, I think you might enjoy it. Check out our website. All the videos are up there. All of the podcasts are up there. The blog is up there. We're extending all of our resources to you so that you can find out all the information you want at any time that's convenient for you. Soon, we will have the online chat feature. Soon, we're going to have more information in there for the help desk. I think you're going to find our efforts in 2022 to reach out to you and communicate better than they ever have been, and we're always looking for further feedback. Thank you so much for being our clients and friends and extended family. We look forward to a great 2022.